Hello and welcome to Options Guide TV. My name is Brian Overby, author of the Options Playbook, and your host for about the next 20 minutes here on Options Guide TV. Going to be short and sweet. We went through a lot of deep into money strategies last week. We talked a little bit about selling calls against positions that you wouldn't mind getting rid of going into the year end. That's one of my favorite things to do. I always like to do it or start thinking about it over the Thanksgiving holiday and look to sell some premium that will get called away before the Christmas holiday or the holiday season, if you will, and before the year end. So if you're interested in that, go back and review the Friday show, because we talked about alternatives like buying deep in the money call on positions that maybe you have a nice gain in and that you still want to stay in, but you don't want to have all the risk on the downside. We talked a little bit about NVIDIA as one of those stocks and how to add to that position, even if you don't have the capital involved to do it. So let's do it by buying a stock surrogate. And now I also mentioned that on Monday, I'm going to look to do a trade in United Healthcare, UNH. And I came up with it. I'm going to look at two trades today. And the fact that UNH is going to be announcing earnings on January 15th kind of popped up in my head. And we've done a recent diagonal and synopsis going into their earnings. And their earnings is on the 10th. So that's going to be this week. But we're already out of that trade. Had a nice solid move to the upside. It only took 2 days to actually get paid on that trade. So in this one, we're going to buy the January 16th expiration. And we're going to go a little bit, just a smidge out of the money. And then we're going to sell something a little further out of the money that's going to expire previous to that, about the halfway point in that position. So let's run to the Tradier Pro software. And we got a down market today. So that's a good thing to be able to set up this trade. And it's part of the reason why I thought about doing it. We looked at the chart. UNH is in a period of consolidation right at the bottom of that big gap downturn. And we already did a couple of bullish trades when it was sitting right at this little area and did pretty well with them. And so we'll do a short-term bullish trade on it. But this is the trade that I'm the most interested in, which is going to be, I guess you would call it a diagonal, but a lot of people just think of it as a time spread, in that we're going to be buying the expiration that contains the earnings. So our concept would be that we think implied volatility is going to increase as that earnings date approaches, which is one of the biggest battles in buying options, period, is trying to figure out what's going to happen with implied volatility. The one time you're almost always certain something is going to happen, or the direction of implied volatility, is around earnings. So we're going to be buying the pumped up volatility and selling the not pumped up volatility. In other words, we're going to do what's counterintuitive. But this is the only way I really like to trade time spreads. And I'm not doing it to get into earnings. Is that ideally this is going to be a low risk trade and not looking for a huge reward, but we're going to put a couple of variables on our side when we put this trade together. So earnings January 16th. So we're going to run out to the January 16th expiration, 39 days away. The actual the actual earnings date is on the 15th. So it's the 1 day prior to the 16th. And we will be buying, let's see here. We're going to go a little bit in the money. We've got the market right at 326. And vol is a little bit pumped up. And I always, first of all, want to do this little gut check. Okay. So right now, they're forecasting that it's on the 16th. The date can change, but the marketplace believes that is true because you see implied volatility on the 9th at 31. On the 16th, it's at 36. So marketplace thinks something's happening between now and then. So we're going to be buying that option contract. We're going to look at buying the 750 call option. We're going to go right here. We're looking right at the 30 delta. I don't mind speculating even a little bit more and looking at the 360 delta, but obviously you got a little bit more risk because the market's you're hoping that the market at least gets to that level and beyond. So for right now, I'm going to stick with this one. The ask price is $7.75. That's the one that we're going to be buying. And then we're going to look to sell something a little bit out of the money. So if we cut the time in half here, you're about 18 days, which would be December 26th. You can still get some premium because we're 18 days away. And our one option contract, we got it down here, loaded into the trade ticket at 350. Now, I don't want to sell the 350 in that. We got a lot more strikes in this expiration because it's a standard weekly expiration. Or not, I shouldn't say standard. It's a weekly expiration. And the 350 here is trading for 225. So we could get this whole thing done for about $5. Well, yeah, little more than $5 on the trade. Or if we want to give ourselves a little bit more upside, we could look to do the 352 50s. That would mean that we're 5 points wide. And if you think of this as just a standard vertical bull call spread, that's where my mind starts when I'm doing these trades. So I'm going to buy the more expensive, closer to where the money is at, and then I'm going to sell something out of the money, which I might just do around earnings anyways, right? So that's a trade, a bull call spread. If I want to get bullish around earnings, is a very popular strategy to do because you're buying one option contract that has implied volatility and selling one option contract that has implied volatility. Now we're just trying to do the same type of scenario, but we're hoping implied volatility pumps up. We still need the stock to go up if we do this trade. It's not like we're totally neutral on the stock. We hope the stock to drift higher, but how much higher before we get to the first expiration? And that's the key. And I'm going to look at doing the 350, 250. But once again, I'm going to say, if you want to risk a little bit less, you can do the 350. Now, it's all about delta if it does get in the option. In the, no, I'm sorry, 355 and 350, 250. So I'm looking at doing, on this expiration, we got the 350, 30 delta. Okay. The standard deviation was kind of throwing me off here. But so now we're going to sell something that's just out of the money. So we did 350. You could do 350, 250. I want to do the 355s is a trade I want to do. All right. So buying 750, selling the 355. Should be bringing in December 16th. Come on. We need it to move. We need the bid ask to move on this trade. Let's get rid of it and let's try re-entering it. 355. No. Here we go. January 18th. 355. Hit that. There it goes. So the total cost of the trade, if you buy the 350, sell the 355, the midpoint is $6. That's $600 per 1x1 diagonal spread. And that would be on the floor. You would call this a diagonal. And that is because if you're looking at the quote boards, like if they were across the screen, you're going diagonally to get a quote. You're buying this option contract at a lower strike, then you got to raise your eyes and look at that option contract at a higher strike. So the quotes based off of the strikes go diagonally on the quote board. And that's where the term diagonal comes from, as opposed to a horizontal or a traditional time spread where you buy the same strike and sell the same strike. You just have different months, but your eyes go just horizontally across the board. So buying the 350, selling the 355, $6 is the midpoint, and that's $600 of risk per 1x1 diagonal spread. You want the market to go close to the 355 level. You don't want it to go beyond. Now, here's what happens on time spreads is that if the option contract you sold gets in the money, it goes against you a lot harder than the option contract with a longer expiration. In other words, delta is dynamic. Gamma takes over and drives delta to one quicker on short term in the money option contracts. And so the short term option contract will hurt you more than the long term option contract will help you. But we offset that by doing the diagonal. We're buying a 30 delta, and right now we're selling a 13 delta for let's call it 14. So you're about one standard deviation move away. And if it makes that move, well, then, and it goes beyond 355, or if it hits 355, we're out. We're just not going to, we're not going to deal with it anymore. We're either going to close the trade if it hits 355 before the December 26th expiration, or we still have the potential to roll it because we have two more expirations before that earnings date. As a matter of fact, we could even roll it to the January 16th expiration if we wanted to. So we do have some options, but in this instance, I think it's a good time to think about doing a diagonal trade or a time spread, something heading into the United Healthcare earnings. Now, if we look at the chart, I want to show that area. We looked at it a lot on Friday. But here's the gap area that we were talking about from here to here. So we rode this area on up in this range, and we came all the way up, and we literally filled the gap, just like it was almost like we were supposed to do it, right? It was listening to Options Guide TV, and it got right up to here, and now we've came all the way back down, and now we're in this area just hanging around the 20-day and the 50-day. This is a bearish signal here when you got the 20 that crosses over the 50. It's called a death cross. That doesn't mean as much to me. It means the more interesting moving average technical thing is when a 50-day crosses over a 200-day. 200's in the green here. That is more interesting to me. Crosses above or crosses below, because this just happens kind of frequently. I mean, you do have a situation where, you know, we move through here and then boom, had a big downturn there for quite some time. Tried to cross over here, didn't quite make it, and then eventually did, and the market ran back up. So it's worth noting, right? It's one of the things to look at, and we're right in here. So we're sitting right in this range, and let me zoom in this little area now, and you see this period of consolidation that we have. We're bouncing off the 20-day, can't quite break through the 50-day. Earnings could be catalysts, but I still think that the market wants to go back to this level. And if it does, every time it gets up to that resistance line on the upside, every time it touches, it makes it harder and harder for it, or harder and harder for the resistance to hold and not break through the upside. So, yeah, and fundamentally, you know, the company's trading right now at a 15 times earnings, and I've mentioned the insider trading quite a bit. Warren Buffett making a big stake in United Healthcare, so I'm personally am long just shares of it, and I bought, and so on the shares I'm about flat because I bought some back there when we were looking at that move to the upside. So I haven't really knocked it out of the park, but it's long-term hold to me. It's I think that you should own some healthcare in your portfolio, and instead of just all tech stocks, right? I think it's a good offset to the risk of a lot of the hyperscalers that are out there. All right, I see one little comment, and you know, good morning. A lot of letters in that name that are popping up. And if you have any other comments, feel free to let me know. This is an advanced trade. You don't want to fall asleep on January 6th, or I'm sorry, on December 26th. Well, you probably don't want to fall asleep that expiration anyways. I didn't even really realize well, that's right in the middle of the holiday season. But with that said, you want to be aware on that trade. You do not want to be assigned on this short call option, and your broker is not going to be happy about it either because it's a fairly expensive underlying. You are covered. You don't want them to exercise the long option contract. If you were to get assigned and you fell asleep, you want to go out and get the stock and give it to them. And that's the way that you want to do it. So this, when you're dealing with multiple expirations, a lot of times even brokerage firms, depending on where you're trading, don't quite get it either. So it's very important to understand that you do not want to be assigned on that 355. You definitely want to have an alert right around 350. You're happy if it gets to that level because you're long, a longer term, it would be at that point in time at the money or in the money option contract. All right. Let's look and see if we can get this dead cat bounce off the 20-day moving average right here. I wouldn't even call it that because we're not trying to catch falling knives. We're just in this period of consolidation. As a matter of fact, if you were to draw a trend line right off of here, not quite, and then this kind of forming a wedge pattern a little bit. But we have, let's look at doing one of our open wing butterflies. Let's maybe we'll stay in that same expiration. I'd normally do 11 days. Yeah, let's do 11 days. Let's do 11 days. We're gonna just be bullish here. Okay, so if we go back to the chart, the top right here is 340. So obviously the 50-day seems to be providing some resistance to the upside. And we're at 325, 15, that's 35, that's 15 points. That's not bad. Let's see if we go 15 points. So we go 325, 15 points, 340. Yeah, we're getting something for that. And then we'd stop short at the 240. Yeah, okay, I like it. Here we go. Buy at the money, sell two out of the money, and buy one here. Oops, too many. Didn't get rid of our diagonal trade. Buy. That might be a little bit too expensive. For 10 points. Let's look at this one. That's a 1 standard deviation move. It's right where the resistance is at. I'm going to look at 2 of them. Okay, but let's look at this one. Let's see how expensive this is. This is going to be fairly expensive. 345. Oh, charts. Yeah, we're going to go back to 340. Sell 2, buy 1. $5. That's not bad. $5 to make $10. Yeah, and then yeah. That's not bad. Okay. So send this to the what if calculator. Okay, so the math works as this is $15 here. Let me check these boxes. The difference on the long spread is $15. The difference on the short spread is $5. 5 minus 15 equals 10, implying that if the market goes above our strikes and hits 345 from there on up, this trade would make $5. And now based off of this, it's kind of saying we came in at 456. That's the price that it grabbed, highlighting that over here and added this nowadays. So it's right here. So you would make 544 on this trade everywhere above the 345 level. If it goes out right here, we could make 1,000 or approximately based off of where we get filled at, approximately, and it's showing you right here, $1,026. And then our risk is the $5 on the downside. And this is where the profit and loss, and this hasn't been working as well in the what if calculator, but now it's looking strong. So to start with, This area, if the 20-day doesn't hold, we don't have a lot of risk over the first week. But as the expiration approaches, this line is going to work its way down. So we got some time until we're down about 250, where it would be right about here. My eyes are over following right on this line, right? And so there we would be down 250, right about there. So we got a little room to run if we say that we're going to get out if we lost half of our value on this position. On the upside, if it blows the strikes away, we could make 500 on the trade. If we land somewhere closer to the middle strike of the butterfly, we could make as much as 1,000 on the trade. Don't mind the risk reward. I like where the chart is at, period of consolidation, going into the end of the year. I like this trade. I like this, and this was the trade that I foreshadowed on the Friday show. I just woke up this morning and started looking at it and noticed that the earnings are going to be in January, and decided to add the diagonal trade to go with it. All right. I don't see any other questions. This will be the official paper trade, is the open wing butterfly in United Healthcare going out to the December 19th expiration. Gives you something to do while you're shopping, doing your Christmas shopping online. Gives you a little something to watch. If the market goes down and you're down about 50% on the trade, look to get out. And that's looking at this point in time. Every day that goes away, this line's going to start trickling down towards this. But, you got 10 points to the downside before you start getting a little bit more nervous around the 314 level, before you're a little bit nervous about where your trade's going to end up. That's it for this edition of Options Guy TV. We'll be back on Wednesday, and we'll check out this trade, and we'll take a peek at, on Wednesday, we'll take a peek at some of the deep in the money call options that we put together on Friday, just see where they're at, and we'll go from there. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.